Hello and welcome to Charting the Markets on Tuesday, the 21st of February. Overnight, we had the Reserve Bank of Australia out and basically its minutes saying that it was considering rate hikes between 25 and 50 basis points at its February meeting when it took its interest rates to 3.35% because inflation remained sticky in Australia. Now, this follows hawkish declarations by the ECB Governing Council member Olli Rehn, who said that the ECB will probably reach its terminal rate this summer. Money markets are pricing in a terminal rate of 3.5% for the ECB, 4.5% for the Bank of England, and 5.25% for the US Fed at the moment. So let's just have a look at how this affected equity indices in Europe. And let's start by looking at the FTSE 100. And as you can see here, we started off the day by falling back to levels last seen on Friday of last week, as the UK has actually posted an unexpected budget surplus, where you have self-assessed income receipts at the highest figure ever in January. So setting a record there, partly offset by substantial spending on energy support schemes and large one-off payments relating to historic custom duties owed to the EU. So the FTSE 100 did come off at first, but now it's recovering on the back of several European flash PMI numbers coming out today. Also later on, we'll see that in Canada, for example, with regards to CPI. But you can see that every time we do come off, we seem to be bouncing back. So at the moment, we are back above this February uptrend line, which we had briefly fallen through earlier today. And we'll have to see where we close today, because basically, from a technical perspective, we are still in a position where the all-time record high, which was made last week, at just below 8,050. That basically hasn't been confirmed by the relative strength index at the bottom of our chart here, which is still pointing lower. So we are still seeing negative divergence and still seeing this wedge formation, which potentially could lead to a bearish reversal if we were to fall out of this wedge. So basically what we need to see today for a top to be formed is to fall through Friday's lower at 7,954. And as long as that doesn't happen, we are basically just trading sideways, and we may retest the all-time record high with regards to the FTSE in the days and weeks ahead. The same goes for the DAX 40 contract, because as you can see here, this contract also fell earlier today on this hawkish rhetoric from the Reserve Bank of Australia and market participants worrying about inflation remaining sticky in other countries as well, and therefore central banks globally basically continuing on their hawkish path. But as we can see here, we retested Friday's low and are currently seen bouncing off it. So yes, we're still down on the day and still below this uptrend line going back to January of this year. But basically, if you look at the DAX 40, it is still trading in a sideways trading range. Now, for a top to be formed, what would have to happen is a fall to take us to below the 10th of February low at 15,245. Because that at the moment with the 7th of February low at 15,272 is acting as really, really good support. We're holding above there every time we test it, and we've basically been trading sideways with regards to the DAX 40 since the beginning of the month of February. But if we were to fall through 15,245, we would then be heading back down again towards this key support area made up of the January lows, the sort of mid to late January lows, between 14,992 and 14,904. So that would be the key support area to look out for. And that's also where the October to February uptrend line can currently be seen. So as long as we stay above there, from a medium-term perspective, we still look bullish. Having said that, we still have, as you can see here, negative divergence on the daily chart, meaning that there might still be a possibility of us stopping out here. So for the time being, further range trading to be seen. Short term, if we were to fall below today's low on the DAX 40 at 15,284, that would then increase the odds of that 15,245 level being retested and being fallen through, in which case we could then head back down towards the uptrend line and decline again. But as long as we stay above today's lows again, we may see another hammer formation like we saw last Friday take shape, and perhaps further upside in the days and weeks ahead. Now, with regards to US markets, if you look at the Nasdaq 100, which was shut yesterday because of President's Day in the United States, you can see here on the daily chart that we basically last week failed below this key resistance area made up of the September and also the February high, February of this year and September of last year, between 12,896 and 12,902, and have then basically slipped through the 2023 uptrend line and retested the mid-February low. And that was tested overnight on this daily financial bed earlier today. So far, we're holding above here, and we'll have to see whether later today, when the US market opens in earnest, we will fall through this level or not. If we don't, we could then have another attempt to the upside, because we would then be bouncing off support. If we were to fall through 12,203, the February 10th low, though, on a daily chart closing basis with regards to the Nasdaq 100, then the 200-day simply moving average at 11,893 would be in focus. The hawkish rhetoric coming out of the Reserve Bank of Australia's monthly minutes of its last committee meeting basically led to some US dollar strength taking shape again. And we can see that with regards to the euro-dollar chart. If you look on the daily financial bed here, you can see that we basically have come off again earlier today. Yesterday, little happened. We can see very little volatility trading here going on with regards to this doji having been formed, simply because of the US being shut because of President's Day. And today we did slip slightly lower with regards to euro dollar. But from a technical perspective, what we are seeing here is basically we are between a rock and a hard place. Because basically, if you look at resistance, we can see the December highs together with the mid-January lows and also the mid-February highs between 107.36 and 108.04 act as really strong resistance. And as long as we stay below 108.04 on a daily closing basis, the trend continues to point lower with regards to euro dollar. And if we were to fall through last week's low at 106.13, we would then most likely be heading back down again towards the 104.84 to 104.44 support zone. And this basically consists of the mid-November high, the early December low, and also the low seen in January. So for the time being, basically, further small slides towards lower levels likely to be seen with regards to euro dollar. But as you can see here, the fast downside momentum we saw at the beginning of the month has now given way to more gradual declines with regards to the euro dollar exchange rate. Euro sterling, however, is still quite volatile. As you can see here today, we have slipped quite significantly and are now heading back down again towards the December to February uptrend line, which is currently being tested around the 88.30 mark. And if that were to give way, we would likely be heading back down again towards the current February low at 88.04, and a slip through there would then put the January low at 87.22 back on the cards. But if we were to hold above 88.04, the current February low, we may see a recovery of that uptrend line, take us back towards the psychological 90 area, or 89 area, sorry, first of all, in the days ahead. But short term, as we can see here at the moment, euro sterling is clearly pointing lower. Now, I'd like to move on to dollar yen, because from a technical perspective, what is happening here is very interesting indeed, because what we are seeing here is a retest. And we are trying to leave this key resistance area I've been mentioning for the last few months, really, between 133 yen and 63 sen and 134.77. That is to say the January high, because we tried to rise above there and did reach 135.11, but didn't close above 134.77, the January high last week. Instead, we finished up within this key resistance area. And today we're still trading within it after Japanese manufacturing shrank to a 2.5-year low. And this was the fourth consecutive month of contraction in factory activity, and the steepest pace since August 2020, as both output and new orders dropped the most since July of 2020, and foreign sales shrank at a steeper rate due to feeble global demand, and buying activity declined further in Japan. Having said all that, Japanese services PMI data rose to an 8-month high, and the latest figure marked the sixth consecutive successive monthly expansion in services activity and the fastest pace since June of last year, as the most recent wave of COVID-19 pandemic basically subsided, with order growth accelerating and new business from abroad increasing slightly, basically. So we had sort of conflicting data coming out, therefore, with regards to the PMI data in Japan and also the manufacturing data coming out of that country. But if we were to manage to close above 134.77, the January high this week with regards to dollar yen, then we would have formed, from a technical perspective, a bullish reversal pattern. And that would then likely take us back up towards the 200-day simple moving average at 134 yen and 95 sen, and also back towards the mid-December high, which can be seen on this daily financial bet at 138.17. So really important resistance that we're testing at the moment. We'll have to see whether we can break through that resistance area, in which case further upside is likely to be seen with regards to the dollar versus the Japanese yen. Now, if it were to cap again, support would come in at the early February high at 132.90. But as long as we stay basically above the mid-February low at 129.80, you can see here the January to February uptrend would remain intact. The stronger US dollar has had a detrimental effect on commodities of late, and we can also see that with regards to the price of WTI crude oil, which has come off over the last few days and continues to slide, albeit at a slower pace. I mean, yesterday we had a small bounce back, but the US was shut because of President's Day, and therefore this was a very low volume and volatility move, which today was followed by a further slide. As you can see here, we slid for most of last week, and we may retest last week's low at $75.33 this week. And if so, it's quite likely that we would also then be falling through the $73.67 late November low towards the January and current February lows at around $72.64 and $70.50. So that's the downside target, together with this December to February uptrend line, which currently can be seen around the $73.12 mark, as long as we basically stay below the mid-February high at $79.75. So basically, provided we stay below $79.75, further downside is likely to be seen with regards to the WTI taking us back down again towards the $72.50 mark. Now, moving on to gold, what we've seen here is a slip from its 9-month high at $1,959 per troy ounce at the beginning of the month towards the support area I've been mentioning for the last 2 weeks, which basically is made up of the early and mid-December highs between $1,824 and $1,810. And it's exactly where the price of gold basically stabilized last week at $1,819 per troy ounce on this daily financial bet, before we bounced back last week. But the bounce was very shallow and basically fizzled out at $1,847. And as you can see here today, we're slipping back down again towards the support area. Now, if we were to fall through it and close below the $1,810 mark this week, we would most likely then be heading back down again towards the November high at $1,785, and also the 200-day simple moving average at $1,776. For the bulls to regain control with regards to the price of gold, what we really need to see is a rise above this last reaction high last week in mid-February, and that is to say a rise above this doji pattern, which was made on the 14th of February, and it's high at $1,870. So only a rise above there could mean that we could resume our uptrend, which was made from November of last year. But as long as that's not the case, further downside is likely to be seen with regards to the precious metal. I'd like to finish up on copper, because copper has been quite interesting. As you can see here, we've been trending higher since October of last year. And, excuse me, made a high at $9,951 per ton in mid-January before slipping all the way back down again to last week's low at $8,787, from which we've now bounced back. And as you can see here, we've managed to break above the last reaction high, which was made at $9,064, and managed to close above there yesterday. So we'll have to see whether today we can replicate that, because yesterday's volume was not that great because of the US market being shut. But if today we could again close above $9,064, then the odds are pretty high that we are forming a minor bottom here, and that we come out of this bottom heading back up again towards the high seen in January at $9,951, which could then also take us towards the psychological $10,000 mark. So long story short here, basically, as long as the current February low at $8,787 underpins, the uptrend from a medium-term perspective seems to remain intact, and short-term we seem to be forming a bottoming formation, meaning that further upside is likely to be seen with regards to the price of copper going forward. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.